All right, learn financial models and you will be smarter than 99% of investors. The financial model is not just about forecasting a company. It's a thinking tool. We use it and build it to reflect the key drivers of the company. So we know what will move the stock and use it to estimate our risk and reward for buying the stock. So MSCI is likely worth a $6.20 a share over the next 12 months. Now today it's about trading $5.60 a share, so that's about a 13% upside. And long term, this business could compound at 15% a year. And the key driver is the growth of its subscriptions. Just as a quick background for context, right? They sell index data. Now, index data is just like the S&P 500 index. It's a way to measure the market and a way to give investors access to that market. So they sell that data with a subscription. It's just like Netflix, right? You sign up and you get access to their videos and their film. MSCI, you sign up, you get access to the data. So they're selling a digital product. Now, if this accelerates to 12%, well, now the stock can easily move up to $6.50 a share. Now, how do we estimate all of this? Well, it's the financial model. So in this video, I'm going to show you how to use a financial model to actually analyze and develop a view on a company like MSCI step by step. Now, what we want to do here with a financial model is turn this raw data, so this stuff from the 10K and the 10Q and all the KPI tables, so these are all the various metrics they provide, and we want to turn it into an output like this, which is a valuation summary, right? It's a price target for the company that has been built up with our assumptions so we know what to do with the stock. Now, every business comes down to these 5 or 6 drivers, depending on how you group them. We can structure our financial model essentially around this high-level financial structure of how it works. Now, as an example here, I have the consolidated sales metrics. So that would be a revenue driver for the subscription sales. And you can see also I have a reinvestment driver, which is a driver for the investments that they're doing. Now, I call them drivers because they're like inputs that drive the forecast, right? These are the things that we estimate that'll eventually help us forecast the earnings per share of the company and value the stock. Step 1 is identifying, okay, what are we actually going to look at? So for MSCI, we have the different segments. And let's think about if it's a subscription business, how would we expect all those sales to start flowing into the business? Well, they have metrics like subscription sales, they have subscription cancellations, which makes sense, right? You're looking at how many clients or customers are buying new subscriptions or canceling. And so when you put those together, you get what they call run rate, which is the total value of subscriptions. So that's going to be the metric we'll use. And then when we want to start thinking about forecasting it, it's like, well, the general way is to think about like what the industry is doing. So for this example, industry is probably growing around 6 to 7%, and we might get some price increases. And so that's why I'm going to forecast here at about 3% growth in sales, which translates into about a 9% growth every year in the index subscriptions, right? So very simple thinking. Now, when you forecast revenues, you do have to be mindful that every business is driven differently. So that is a subscription business model. Now, for example, they also have the asset-based fee model. Now, that's slightly different. This is not a subscription model. What they do is they license out the index data for an ETF to use. Now, the ETF is going to pay them as a percentage of assets. So for this business, I'm actually going to be forecasting it based off the growth of assets. Now, again, I can maybe just use the current growth rate because, it's sort of dependent on what's in vogue of what people are investing in. And then the actual price of the fees, right? I'm just keeping it flat because the overall trend of ETF fees are going down. But in any case, it's a very much like a volume price, if you've kind of heard of that before. of forecasting the asset-based fee line. Okay, so we do that with all the different segments, and you can see that once I've forecasted all of them out, we get the income statement output, which are the different revenues for the different segments. So we've already taken care of the revenue side. Okay, so now step 2. Let's now jump into what are the cost drivers of the business, right? These are the unit costs and the operational costs. And now here's what you want to think about from a business model perspective. Okay, so when we get their sales, and what are the type of costs that they have, and how are they going to be profitable? The metric that we want to use for MSCI is the EBITDA. Now, the reason why we want to do that is because, one, this is the metric that they give for the different segments. And EBITDA is a pretty clean metric because, well, one, it stands for earnings before interest, taxes, depreciation, and amortization. And when you remove the interest, you're removing the costs of debt. So you're removing the cost of capital. You remove the depreciation and amortization, which are really costs related to investments, which you'll see in a second. And then obviously removes tax. So it's sort of like a good measure of profits for the business before the expenses related to investments as well as capital. So when we look at MSCI, what is the assumption that we want to make here? Well, it's a very profitable product. You can see very clearly. I mean, it's 60, 70% margins, which is really huge. And that reflects the fact that it's a digital product, right? When they're selling additional subscriptions, it's just like with Netflix. If you sign on a new customer, you don't really have to pay more to deliver it to them. You just replicate that product and sell it to them. You just make a copy of the code, and when you deliver it over the internet, it's a lot cheaper, right? So with MSCI, we're just forecasting margins to be stable, maybe improve slightly to 60.4, just because this is a digital product that has a lot of profits. Now, one of the metrics that we can also use to validate that and also compare over history is the incremental margin. So incremental margin is the change in profit versus the change in revenues. It just tells you how profitable is new growth. If we look at it historically, we can see that the incremental margin is very high. So that gives us confidence in our margin forecast of their profit margins to stay at that level. Okay, so that gets us to the different profits for the different businesses. Now, when you want to look at the rest of the income statement, really what we're doing here is just plugging in all the different things like interest costs, depreciation, amortization, and we're plugging them in because MSCI actually gives it to us in their guidance. So you can see here, this is from the earnings presentation and earnings release. They've given us the guidance for all these different line items because they've forecasted it within internally as well. So once we plug all those things in, already we've gotten our forecast for the profits of the business, which is net income. Now I made a couple other adjustments, which is mainly just removing acquired intangible amortization. This is just expenses related to acquisitions. Long story short, it just means that these expenses they're non-cash, they're not really operational, so they're typically removed. And that's how we get to the adjusted earnings per share number. This is a number that investors track. This is what the market tracks. And so this is what we're going to use to value the company. Great. So now we have our profit forecast, right? Now let's start thinking about the cash dynamics. Well, the cash, if we jump back into the drivers, well, they can be used for reinvestments. They can use for working capital. So let's go through these. First is the reinvestments. Let's go into that because that's more important. There's really two metrics that they have here, right? So first is capital expenditures, and the other is capitalized software costs. Now, when we think about it from a business standpoint, what that is if they start expanding into a new location, right? Maybe buy more computers, get more office space, that would be capital expenditure. That goes into the property and equipment line for a balance sheet. If we're looking at the software side, say they decide to develop new software, that would be the capitalized software costs. Now, the reason why these are split up is just from an accounting standpoint. Usually we split up tangible stuff, so that's physical stuff, versus intangible stuff, that's non-physical stuff. And so that's these are the two investments. It's a digital business. When we think about the assumptions, well, I mean, general assumption is that this business is going to keep investing, right? So they can keep growing. And so our forecast really we can use is just keeping it stable as a percentage of revenue. So as the business grows in revenues, the investments grow as well. And then from an accounting standpoint, investments are put on the balance sheet, meaning you create assets. So when we look at the balance sheet, and this is connected to our forecast, you can see that the property and equipment and investment lines are both going up. So that's how we're forecasting the balance sheet assets in our model. Now, from a working capital standpoint, I'm just going to be very brief on this because it's not super important usually for a company. But working capital are things like accounts receivable, so how long it takes to get money from your customers. Also accounts payable, so if you're paying your suppliers, maybe you pay them on credit, like you pay them over time. And so all of these are like they're also called operational assets and operational liabilities, and they're usually current assets, current liabilities. So really what we're doing here from a forecasting standpoint is also growing these with the business. So accounts receivable is just how much you expect to collect from customers. Obviously that will grow as you sell more subscriptions, right? So we're forecasting it just to grow with the business. And you can see from the balance sheet perspective, we see the different current assets and current liabilities modeled out in our balance sheet. So that actually covers a good chunk of the business. Now we can actually estimate the cash flows of the business, right? So now we shift a little bit. We're not just thinking about profits. We're thinking about, well, how does cash actually flow through the business? Well, the typical way, and going to the cash flow statement, you can see that we start off with profits, right? So we start off with net income and we adjust it for the non-cash expenses. So things like stock-based compensation doesn't involve cash, depreciation and amortization doesn't involve cash, and working capital needs, well, we also need to adjust it if they're using more or less working capital. So when we put all those things together, that's how we get the total cash generated by the business, which is the cash flow from operations in the cash from operating activities, right? So that's the total cash that's generated by the business. And then we got all the investments, right? So all the stuff that they've invested in capital expenditures as well as software. So those are all in the cash from investing activities. So we take the cash flow and we minus in we remove or minus the investments, right? They're paying out that cash for investments. And that's what we get as free cash flow. Now, over time, free cash flow and earnings directly match, but free cash flow is generally preferred a lot of the time because you can see the impact of investments right away. So we have free cash flow, right? We have the cash from operating activities minus the investments. And this is also important because this also represents the cash that the business has. It's called free because they can use it to pay shareholders. And we want to be very... We're forecasting this because we can use this to value the company, right? So we're going to get to that shortly. But last step is now that we have the business modeled, we want to also start thinking about the capital flow. So how money is flowing in and out of the company. So this is where the step 5, where we're thinking about the capital sources of the business. Now, if you want to take a step back and think about, like, where does a company actually get money from, right? There's really just two sources. First is you can borrow money, so that's debt. There's actual debt that you get from borrowing from investors or from the bank. There's also deferred revenues, which is sort of like borrowing because that's just cash up front from customers, right? Like if they're signing on for an annual subscription, they pay it up front. Well, it's like kind of like you're borrowing cash from the investor. But from a forecasting standpoint, there's besides deferred revenues just growing with the business, obviously you get more subscriptions, you get more deferred revenues. Debt is just staying the same because MSCI hasn't indicated and that they plan to do any debt raises, right? So we're not actually doing that much modeling in the debt side for this company. But so you can see that when I'm showing you the balance sheet, we filled out the liabilities part, but there's really no change because besides just deferred revenues growing with the business. So the second source of money for a company is equity. Now that's like selling shares. Now but there's actually like a number of different ways it can flow in and out. So for equity, I actually just want you to think about like how does money actually change hands when you're dealing with shares, right? So the first is the common stock. So this is when the company is first founded. And so this is usually very tiny because it's just the initial, money that was put in to start the business. This is more relevant for after the company has grown, but now we start to think about like additional paid-in capital. So if the company has decided to sell more shares, or if they do stock-based compensation, so pay shares, that all is considered the additional paid-in capital. Now the second thing is the treasury stock. So if the company decides to repurchase shares, so do buybacks, well, then that means they're giving cash back. And so that's why it's considered a negative. It's an offset. Now, the third way of getting cash from an equity standpoint is if the business just accumulates earnings. It retains profits, and it's profits after they pay out dividends. That's what this one measures. So our assumption here, just from how MSCI is growing, well, they're clearly paying employees with stock options. So we want to model in an increase in the additional paid-in capital. They're also repurchasing stock. You can see that's what they've been doing historically because they want to offset the increase in the number of shares and also return cash. And MSCI also pays a regular quarterly dividend from their profits. So we can see that our forecast shows the additional paid-in capital going up from stock-based compensation, treasury stock becoming more negative because it's a return of cash. That's from the repurchases. And then the accumulated earnings, right? We're seeing that rising from the net income minus paying out any dividends, right? And just stock-based compensation, we modeled it as one of the expenses in the adjustment part of the model. So to put it all together, we can now see all the different ways that equity is flowing with MSCI, and we can also compare it with the cash flow of the business, right? So remember, cash flow is just the available cash that the business can use to pay shareholders or do whatever. So MSCI, you can see that they're using the cash to pay a dividend and also buying a ton of shares. They're giving back a lot of capital. You're going to see why that matters shortly in a second. But to sum up, we've now forecasted the equity side of the business on the balance sheet. You can see we've forecasted all the different lines in the statement of equity. And so now our balance sheet is now fully modeled with all the different capital flows. Now, from the cash flow perspective, all the different capital flows can be lumped together in the financing activities section of the cash flow statement. And so now everything is connected. You can see the total change in cash. We have the cash from the business, we have cash from all the different investments, and we have cash from the different capital flows or financing activities. So that's how the cash flow statement works. Well, we can take the starting cash, we work out the net change in cash, and we work out how much cash how much cash this business has at the end of the period. And then because the model is connected in all these different ways, you can see this also matches what we have on the balance sheet. So it's worth taking a pause here because this is how we've modeled the whole business, right? We've modeled all the money flows of the business. We forecasted earnings per share, which we know we're going to need for valuing the company. And we also forecasted the cash flow of the company, which we can use to value as well. Now, before we do that, the great thing about a financial model is now we can extend this logic. So just assuming that MSCI will keep growing like this and just see how it will play out for the next 10 years. You can see I've got my quarterly forecast, but I actually have this going for the next 10 years, right? So it's cool, right? So now here, let's actually start valuing the business. And this is where the model really starts to pay off. Because now that we've built the forecast, we can estimate the stock's value. As a shareholder, if we own the shares, we have a claim to the earnings of the company because we own the company. So that's where the value comes from, and that's why we value it based off the earnings per share. Now, how do we do that in practice? Is we price the stock as a multiple to the earnings per share. And that multiple that we can use, we can either reference it to its history, it's like looking at the past price of the company, or we can use like a median or average of its peers. So that's like looking at the price of the overall market that it's in. We take the future earnings per share, we multiply it by the multiple, and that's how we estimate the price per share. So that's a PE valuation methodology, one of the earnings methodologies that we can use. Now we can also do the same with EV to EBITDA. EV just means enterprise value. It's just equity plus debt. And using earnings before interest, taxes, depreciation, amortization, right? Because it's before paying out investment costs, before it's paying out capital costs, it's a cleaner look at earnings sometimes. And so that just gives us a way to be able to compare companies that are at different stages of profitability or different capital structures. So the second approach is valuing a company based off the cash flow that it produces. It's like valuing it like a bond. Now, why do we use that? Well, the first main reason is that it's an absolute metric. We don't need comparisons. It's just cash flow. And so it's sort of like a gold standard for valuing companies. And so how do we do that? Well, it's also pretty simple. We just project out all the cash flows for the next 10 years. And this is why we need a financial model to do that. And then at year 10, we just estimate what we call a terminal value, which is just the value at year 10 that reflects all the potential cash that it could have for the rest of its lifetime. And that's why we use very conservative estimates at that point. So we take all the free cash flow for the next 10 years, estimate a terminal value, add it up, and then discount it to present value. So we need to discount it with a discount rate, which is essentially like a return that investors require for that risk, right? And then we minus any debt or any cash, and that's how we get the equity value. And we divide it by the shares, and then that's how we get the value per share from a cash flow perspective, right? So we got the earnings valuation and we got the cash flow valuation. But if we think about what we just did, we put together the company's strategy and the company's growth into one stock valuation, right? So if the company grows like how we expect, well, we think MSCI is worth about $6.20 a share. And at today's price of $5.60 a share, it implies about a 13% one-year return. Now we think that the business can probably compound at least 11% a year in earnings. And then if we add back the dividends and the buybacks, so the capital return, we're getting an additional 2 to 3%. And when you really get down to it, you can also start to answer things like, what is going to make the stock move up and down? Like for MSCI, why does this stock trade at such a high multiple? If we look at the PE multiple, it's been going up for a long time. Well, we can actually look at something called the expected return on invested capital. Well, that's just the profits as a percentage of the capital invested. Now, remember, MSCI gives back a lot of cash with the dividends and the buybacks, right? So that reduces the equity portion, and that's why the return on invested capital has gotten up to all the way to 30%, right? It's risen every single year. And if you think about it, how much would you pay for an asset that gives you 30% every single year, right? Probably a lot. And that's why the multiple goes up. Okay, so if you want to learn how to build models like this and learn a full investment process, I suggest you check out our training inside the Stock Investor Accelerator. There's a link below with resources. And thanks for watching and get to using your financial model.